In this video, we are going to look at the last direct variance, direct labor. We're going to do the table that shows us how to split that flex budget variance up into two pieces. We're going to compare it back to the flex budget. We're going to do the journal entries, and then we're going to look at another story that might explain the variances that we've seen so far. So let's go back to our overall budget and identify the variance that we're going to look at in detail. So for direct labor, the static budget was $360,000. We made 2,000 extra suits. And at 2 hours per suit times $18 an hour, we should have spent an extra $72,000. So that sales volume variance makes sense. We spent more money on labor to make more suits. But the $138,000 above that, the flex budget variance, isn't explained, and we don't know what happened. Did we pay our workers too much money? Did we use too many hours? There's no way of knowing from the flex budget variance itself. We need to split that into two pieces: a rate variance to see if our rate was too high, and an efficiency variance to see if we used our direct labor workers efficiently or not. We can go back to the vignette to identify the key items here. So going through this vignette, we can see that we should have used 2 direct labor hours at $18 for each suit. Our actual direct labor was $570,000, and we really used 30,000 actual direct labor hours. So let's go ahead and put that into our familiar format. We know that the actual quantity of labor hours was 30,000 and that the actual cost we paid was 570,000. If I take 570,000 and I divide it by 30,000, I get $19. That is our actual cost. The flex budget amounts, we had an expected quantity of 24,000. That's 2 hours per suit times 12,000 suits that we actually made. And our standard cost for labor is 18. So when I multiply that out, I get 432,000. And that is the flex budget amount. Now let's go in and do that third budget. We have an actual quantity of 30,000 from our actual quantity to the left, and we have a standard cost of 18 from our standard cost to the right. And when we multiply that out, we get a third budget amount of $540,000. That means we have a $30,000 variance on the rate. Now, can you tell whether that variance is favorable or unfavorable? Let's think about it for a minute. The actual is higher than our half budget, half actual. So that sounds unfavorable. But the other thing that we can look at is the standard cost versus the actual cost. We were supposed to pay our workers $18 an hour. We ended up paying them $19 an hour on average. And so that is a higher expense and lower income. So it is an unfavorable variance. We generally call this a rate variance, not a cost variance or a price variance, because it's a rate that we pay people. It's a rate that we pay, and we use a rate variance for anything that we purchase on an hourly basis or that we lease or that we have a rate for, like utilities. We might use a rate variance. You can also call this a cost variance, and it would be okay. If we take the difference between our third budget and our flex budget, we can see that that is $108,000. Again, is this going to be favorable or unfavorable? Well, we can look. We can see that the blended budget, half actual and half standard, is higher than the flex budget, so that implies it's going to be unfavorable. But we can also look at that quantity. We were supposed to use 24,000 direct labor hours. We really used 30,000 direct labor hours. Of course, more direct labor hours equates to more money, more expense, lower net income. So this is also an unfavorable variance. We get the flex budget variance by either taking the actual and the flex budget, the two outside numbers, the difference between those two, that's 138,000, or we can add up our rate variance and our efficiency variance. They're both unfavorable, so in this case we sum them. And that also gives us $138,000. And that's our flex budget variance. Let's take a quick look at how this compares to the flex budget that we did before. So we can see that that $570,000 equates to our actual results on our overall variance analysis. The $432 matches the flex budget, and the $138,000 at the bottom matches the flex budget variance. Okay, so let's look at our journal entries now. The first row of the first journal entry that we need to do is to put the direct labor into work in process. And we did 12,000 suits times 2 hours each times $18 per hour. So we're going to debit WIP for $432,000. Remember, everything flowing through inventory has to be at standard cost. The next thing that we're going to do is record the actual outlay, the wages payable or the cash that we paid these workers. And in this case, it's a wages payable amount, $570,000. They really worked 30,000 hours and our average wage rate was $19 an hour. So we really owe them $570,000. We're out of balance by $138,000, right? We already see that on the left. But we can't just put this into one variance, we need to put it into two. So we're going to debit the direct labor price variance for $30,000 and the direct labor efficiency variance for $108,000. And now we're in balance. Okay, so let's talk about another story that could explain all of these variances. Remember our direct materials variance. Let's take a look at that for just a moment. We had a favorable cost variance, but an unfavorable quantity variance. We thought, well, maybe this is because the manager bought crappy material. And that could also explain the labor variances. That story is consistent with this because if the material was really bad, then perhaps our workers had to work additional hours cutting it and piecing it, trying to get the right fabric layout to make all of the suits, and that resulted in overtime, raising our wages. That is a consistent story with all of these variances. Another story with these variances is that we had high turnover. We had a lot of people leave the factory over this period. We had to hire new workers. They came in at a higher wage rate because there's inflation and they didn't know what they were doing, so they made mistakes and they used additional fabric. Our purchasing manager got a really good deal on quality fabric. The fabric was not the issue. It was all of these new employees. That story is consistent with all of these variances as well. So how do you know which story is true? You have to go out onto the plant floor and talk to people. You need to ask questions. So one of the wonderful things about being an accountant in a manufacturing environment is that you get to go out and talk to everybody that is involved in the production of this stuff. You get to try the jobs yourself, perhaps work through all of these procedures so that you know how they work. So when you see a variance, you understand what the potential reasons are and you know who you can go talk to get a straight story. Okay, that is the end of our direct variances. We'll continue on with the overhead variances in another video.